Hi, I'm Jen. Welcome to the webinar. I live in Pittsburgh and I'm Vice President of Client Strategies at ISBA Consulting. We focus on building supply chain and operations for fast-growing consumer brands, and my background's over 10 years in the supply chain and operations space with consumer brands and retail and e-commerce.
Hi, everyone. I'm Stuart Kennedy, one of the co-founders of Vividly, which is a trade promotion management software and a volume forecasting tool. My whole career has been in CPG, working at brands like Justin's, Perfect Bar, or Lily's, starting at each of those companies when they were quite small and then kind of going on that exciting journey from infancy through exit to strategics, and really decided to start Vividly because I was sick of having to manage trade in Excel and trying to use other TPMs that were clearly built for enterprise size CPG companies. The first thing that comes to mind for me with a key difference is e-commerce has really good data and retailer, they just don't. Sometimes, honestly, it feels like the distributor data particularly is like purposefully bad. It's, behind different paywalls to get better data or whatever it may be. E-commerce data is so rich. I think it's just a really great benefit of starting out in e-commerce. You can create really good stories for why you're succeeding and why you're growing and how to make fact-based decisions for your business. And the retail side, the brick and mortar side can just be, I don't know, a little bit more of a black box when it comes to good information.
Yeah, I completely agree with that. I think it's interesting because you can release an ad for e-commerce and then you can say oh, you can see immediately in that hour, something picked up, or you have better buying in these particular times, or after lunch, people like to buy your products. So I do think that's interesting. Whereas with retail and in store, the feedback loop of what is working and what isn't working is a lot longer. I think also around physical presence is something that is really important. A lot of times for e-commerce brands, you're optimizing for, and we advise, people that we work with about this as well, that when you're shipping to your customer, they've already bought into your product. So in terms of creating an experience for them around receiving it, you want it to be a good unboxing experience, but you also want to balance that with cost. Whereas in a retail environment, they haven't bought into your product yet. They have to make that decision when they're in the store. So I think really investing in your physical presence in your packaging, as well as what you're doing in store, is really important too.
Oh yeah. You come into the store and you're thinking oh, what should I buy? And there's the bright, awesome, sexy packaging or the sale tag on shelf and how it just pulls you towards it. It's definitely important. I also think trade and forecasting can be super different versus e-commerce. Trade, especially with brick and mortar, is shockingly complex, especially for small brands that have to utilize distributors, where the distributors end up being middlemen of trade. They're processing the deductions. The trade can actually be based on what you're shipping to the distributor, or what the retailer ordered from the distributor, or what the consumer bought from the retailer. And then you also think of things like sort of the pay to play method of, yeah, sure, we'll bring you into Ahold, but you need to cut us a check for $100,000, or we need the first 10,000 cases to be free.
Mhm.
Those sorts of things. It's a little bit like older style, and it's so relationship based. Needing a broker to be able to get a meeting, with the buyer, and then also because of these complexities of distributors having backstock and the retailer having backstock, things like forecasting can get a lot more complex and confusing for the delay between when I actually produce something and when it was actually consumed finally. Those things can be really difficult to manage on the retail side. And it can also depend on retailer by retailer. I feel like some really have it together, and others don't.
Yeah. And I think it can also be for geographic region, right? So you might be performing well in a particular area of the country, or not another one. And so, just because you're in one particular retailer doesn't mean you're going to be distributed in all of their stores. It might only be their top 100 stores or top 50 stores. And thinking through sell-through based on that and what promotions they're running is interesting. Amazon as a channel in itself, right? It's a lot of it's dictated around the promotions that they have, which is Amazon Prime, which is a complete, their own holiday where they create their own demand, and other brands are following suit. But I think it's interesting because you can't necessarily follow the same buying patterns that you see in e-commerce. And then from like a seasonality perspective, the times of years that there's like open to buys for particular categories as well is interesting, because you might have missed it for a year. And so the planning needs to be a lot further in advance than wanting to launch a product in, a month or so. To start off is like around market research and just like the feasibility. So understanding what product category you're in and where are similar like products sold, because there's a lot of different types of brick and mortar. There's grocery, there's pharmacy, there's the big box retailers like Walmart and Target. You could be in the department store. So there's a lot of different types, and each one of them is quite different. So I think understanding what market you're trying to be in, and that can be determined by price point, the type of product that you have, who your target customer is and where they're shopping, or if you're trying to acquire new customers, like what that customer looks like. And then starting at that top high level view and then doing your research backwards from there, because like to Stu's point earlier around working with brokers or a distributor, a lot of that is dictated, like the retailers are the ones that are dictating that. So if you're working with Whole Foods versus you're working with Nordstrom, it would be a very different approach. So I think understanding the channels that you're trying to target is the absolute first step. And then you can kind of work through what your plan is to get into them from there.
Yeah, I think those are all really good points. I 100% agree. And to that point of how different things can be by channel or category, whatever it may be, I think surrounding yourself with mentors, advisors that have done this before in your specific category, whatever it may be, is just an absolute must. Like trying to kind of figure things out on your own is just never the way to go. Everybody's done this before on some level. And so getting advice from people that really align with your product or what your company's trying to do, I think makes a lot of sense. I think that another aspect is just looking at your business as a whole and thinking, well, do we have a good selling story? Are we seeing our velocities increase? Are we actually going to be able to go to a retailer and have a really confident story that we can sell them on why you should carry our product? If you're struggling as a business or your sales are just sort of flat, whatever it may be, it's probably not the right time to jump into retail. It's really that the consumers are telling you very clearly, I want to be able to access what you are selling in more than just this form. So being really in touch with that e-commerce data that you have to see how you're performing and know that it's almost like IPOing in a way, where it's like you want all your metrics to be looking awesome to take that massive step. And the other piece of that massive step is, with something like e-commerce, it can be kind of this like slow build in volume. But if you go to Target and they say, yeah, like let's do a trial run, boom, you're in 200 stores, that could be a massive order. So, thinking about things like your supply chain capacity, your funding, materials, all of your cogs, like, are you ready to truly make a big jump? Because if you get a broker, create the right relationships, go into a meeting and they say, yeah, we're actually really interested, let's do this. And you don't know 100% confidently that you are ready to say yes and make that jump and stock everything in full and also have the money to fund trade spend or whatever else, then you're just going to burn the relationship. And relationships are everything, I think, in brick and mortar.
And I think the other side of that is like, on top of that, you get that PO, the funding terms are completely different than what it is with e-commerce. You're not getting the money in the bank immediately. You could be looking at net 30 or net 60 terms after you deliver the inventory to the retailer. So from a financial perspective, I think it's really important to consider that. And then also to look at what your costs are and just understanding from a gross margin perspective. A lot of retailers, they require 40-50%. You might be investing that into online advertising. So that's so it's very different financial models for the various channels, and understanding that in advance as part of your initial feasibility is really important. So I don't think you'd want to necessarily pre-buy anything, right? So you don't want to have inventory sitting, waiting to go into retail. The actual process of getting a retail contract signed and product on shelf I think it's a pretty long process. So you should have enough lead time to be able to manufacture for your purchase order. But I think understanding what your lead times are with your manufacturer, whether you're doing that yourself or you're working with a co-manufacturer, and then also what your capacity is. So looking at, okay, roughly this is how many doors I expect to be in this particular retailer. This is the number of units that I expect to sell through per day or per week, and then extrapolating that and going backwards and maybe putting together a rough idea around what a purchase order could look like. And then making sure that from a capacity manufacturing perspective, that you're with a partner that could meet those particular volumes. And if you're not, beginning to explore what manufacturing in parallel could potentially look like would be key. So I think from like an inventory capacity perspective, that would be the first step, but definitely don't pre-buy anything and overinvest in inventory too soon.
Yeah, I was going to say the exact same thing. It's all about scoping out, like, what are we capable of as a business? And if they give us the green light, can we truly pull this off? If you're in the meeting with the buyer right then and they ask you an obvious question like, provide me confidence in your ability to consistently supply us if we do decide to give you distribution, you should be able to easily confidently answer that question. Like, I know this is our capacity. I know we have the capital to create this product, to fund a trade plan, to pay the slotting, whatever it may be. And I think, also to Jennifer's point, you really, like, especially with retailers, there's a window of time where you can meet with a buyer, and then there's this long process of when do you actually get a decision. So, once you kind of get that thumbs up, then there's also this time frame of like, when are you actually going to get cut into shelf? So there's time for you to then quickly do a lot of different things and kind of figure stuff out. But you need to very confidently know if they do give you the thumbs up, can you pull this off? And I think you have to be super honest with yourself. And what I mean by that is I think something that brands kind of can neglect is when to say no. I think it's easy for companies to always know when to say yes. Oh yeah, we can jump into this retailer, we can jump into that retailer. I think smart brands know when to say no, and it's so important because if you do get distribution with them and you're consistently shorting them, or product quality is terrible, your chances of going back to that retailer a year later and having a good conversation are probably quite low. So you just have to be confidently prepared going into these.
Yeah, I think the worst thing that could happen is like a poor outcome once it's not, the worst thing isn't saying no. The worst thing is like not providing the right quality of product and inventory levels. That would be disastrous for a brand.
Yeah, I have a clear memory of when I was at Justin's, and we ended up saying no to this awesome opportunity that would drastically blow us past AOP. Mm-hmm. And we all really wanted to say yes because it was just this amazing opportunity. And we felt like we had the capacity, we could produce this product. But if just one or two things went wrong, this would fall apart. And it was a specific retailer that is sort of known where, like, if you burn the bridge once, you're never in there again for decades. And we decided to say no in that instance. And I think it was so important because 6 months later, we got to have the conversation again. We were ready for it, and we created a good relationship from day one.
And I think as well, like, thinking about one on being ready is around like, and you can see a lot of this information online. They'll have their like routing guidelines available, but are you, like, from a certification perspective, like ready as well? Like, is your manufacturer meeting like good manufacturing practices, just different things that retailers might require just to make sure like you're buttoned up from the beginning is really, really important too.
We've talked a lot about, can you actually supply these orders, that sort of thing, like getting into the weeds a little bit with that, surrounding you with the right people, the mentors, brokers, whatever it may be, educating yourself, as Jennifer mentioned, on that category. Like, do you know kind of what the average velocity is for items in that set? Do you know generally what that initial trial run looks like in terms of number of stores? Can you confidently build that forecast around, hey, I think generally it's safe to assume I might sell 3 units per store per week, and their first trial run is 300 stores or something, like going off of good information. And let's be honest, like this industry is really big and at the same time quite small, and people are always very willing to help each other out. You just got to stick your neck out, ask questions, ask for help, and just make sure that this forecast that you're putting in place, this plan that you're putting in place is fact-based, instead of, I think, leading with kind of ego of like, oh, we can totally do 20 units per store per week. I bet we could get into 1,000 stores. What actually occurs out in the marketplace?
These things are well known, but I think that's just like being exposed to it on a regular basis. If you haven't, been working with different retailers for 10 plus years, I don't think it would be as second nature, and it can be a little bit of a black box. But that being said, there are a ton of resources available in general, and a lot of communities of, consumer goods brands that can meet together and learn from each other. And I don't think that that was available, 5 years ago necessarily. So I think that the environment is really rich to learn at the moment.
Yeah, I agree. I feel like at this point, e-commerce and the relationship between e-commerce and retail has had enough years behind it where the information is out there. It's just on you to seek it and find it. I guess like an example of when I guess there wasn't maybe as rich of information several years ago, I was working with a brand where we got into Amazon, and nobody in the company, even though we had a lot of very experienced people, knew about the soon to come issues between the pricing of what we had at Amazon and the pricing of what we were on shelf in Walmart and in Target and Trader Joe's, where we would start to have items on Amazon get kicked off because they were surveying pricing in Walmart and seeing we have to be this percent discount cheaper per ounce or whatever than this other item, or else we don't want to carry you. Or then, of course, then Walmart coming back and saying, hey, we saw that this is online now at this price. We don't want to carry you anymore because we need the best price. We need this. So you're in this constant battle of, well, who gets the best price? How do we try to keep everybody happy and still keep distribution everywhere? So you start getting creative where e-commerce has this set of items and sizes, and Target has this 12-ounce jar, and Walmart has the 16-ounce jar, and like all these different things to try to get around these and still be able to play in each area and have each retailer or e-commerce platform feel special, and that they're giving the best deal to their consumers. But at the time, there just wasn't enough information or experience out there of like really how these retailers were reviewing information and interacting with online data. But I think at this point, so many years have gone by, I think these are probably hopefully basic things that anybody you would consult with would be able to inform you on and educate you on.
Yeah. And I think that like the visibility now is different now than it was, say, like 10 years ago, right? If you look up a brand, you're going to be able to see it in every single channel, right? You'll be able to see what it's listed for on Amazon, what it's listed for on Walmart. So I think understanding who the customer is at that particular channel and having those different assortments is what is going to make you be successful and stand out in that particular retailer. I don't think that the strategy should be necessarily like same product every single channel. Having like specific lines for specific retailers is really helpful. And it's also helpful from just like an inventory planning perspective and, the supply chain operation side of things, having particular SKUs, different SKUs for different retailers, different UPCs, et cetera. So that is one thing that I think it is important to think about, is what your assortment is going to be with those retailers versus e-commerce.
Yeah, that's a really good point. It makes me think of some of the previous questions on preparing for retailer in those conversations. Are you ready for that buyer to say, cool, I see what your product is with e-commerce. Can you do this in a 6-pack? Or
Yeah.
can you do this in a smaller size or a larger size? Like, are you ready to hear those types of things and be able to pivot and act quickly to slightly change things to have things be unique and have that unique assortment by different channel or retailer or whatever it may be?
Yeah. I think it's like, it does come back to like what looks good on the shelf, and you're trying to optimize like revenue per square foot when you're working with retail. So just like taking that into consideration with the buyers and being able to speak their language and give them a really good return on what they're planning to put in their area is key.
First thing that comes to mind is definitely overextending yourself and kind of having that excited ego with what you think you can accomplish, and instead slowing down and pacing your business strategically to mitigate risk. Because as we've mentioned, you might get 1 or 2 or 3 swings at the bat at most with some of these retailers. I think that is super important. It also surprises me, especially with emerging brands, how little decisions are made based on data.
Mhm.
And also, like, you can be scrappy and get data. You can ask for a favor from somebody that might work with a larger company and has a bunch of category data access or something like that. Anything you got to do to be scrappy and get good information to make your decisions instead of kind of going by gut. I think the less you can go by gut, the better. And then I mentioned earlier, knowing when to say no is a much greater skill than knowing when to say yes, I think, for a lot of these companies.
Yeah. And I think like similar to what you've already said, but like diversifying too early and can be, the death of any brand, like like investing in too many product variations or types of products. And I think really focusing on like product market fit, having success around like a couple of key pivotal lines and then expanding from there is what's really important. If you say yes to everything, and I've been in this situation before with companies I've worked in this past, you're so excited and you want to say yes to everything, but you want to be in every single country, but there's so much nuance and operation, like just operations behind every single decision you make, like going into Target or selling in the UK or like every single adding a new product line, everything comes with different complexities that everything will add a burden to your team. So just making sure that you have the team to support it, the funds to support it as well. Just thinking about from a customer service inbound perspective, like how are you going to manage those new channels as well. So I think that diversifying too soon without having a foundation to your business, whether that be the technology infrastructure, the right like vendors and manufacturers that you're working with, can definitely cause problems.
Yeah, that made me think of how every emerging brand that I've joined, like one of the first steps just guaranteed that I go through is a SKU rationalization exercise. It feels like every company, oh, like we sell cookies and we have the chocolate chip cookie and we have
Yeah.
the macadamia nut cookie. And every 6 months, we're just going to add a new flavor and look at all this new revenue we're
You
getting
really
because we're
want to
getting
do
all this new
that? Yeah.
distribution. And then they have like 30 items. And like a quick example is, when I was at Perfect Bar, we had 5 core flavors that were at the very large share of our sales, and they
Mm-hmm.
did really, really well. And then we had like 10 other flavors that performed significantly worse. And as we, went to meetings with buyers and said, hey, we're asking you to literally discontinue these items on the shelf. Hey, maybe we can like bring in this other item instead, or you should double face our top item, those sorts of things, even if it's literally just removing that shelf space. Now, those people that went and tried your carob bar are now going to actually try the chocolate chip peanut butter bar. And your chance of success of that person in that first moment of trial, liking your really good product and becoming a repeat buyer and a fan of your brand is so much higher. Like, you basically want to always be putting your best foot forward.
Yeah.
And so many companies do diversify way too early. So there's all these different raw materials and packaging, all these things. It's like the best way I can put it is like just do the blocking and tackling really well. Like do 3 things incredibly well as a company and only focus on those 3 things instead of having a list of 20 where you end up doing okay because you're
Yeah.
spread so thin. And things like SKU rationalization is just so important with that. And I think it also applies to a lot of different areas with managing companies.
I think that goes back to like actually analyzing the data on a regular basis and like making decisions based on data and not like the team being like, oh, let's make this new product. It's like, this is awesome. I just feel like it's going to be good, but actually just like looking historically and it's like, actually 90% of your sales have come from these 10 products. Maybe let's like double down and focus in on them. Like, what would it mean if you, I think we're diverging here, but what would it mean if you like really like focused and spent all your marketing dollars on like those 10 products as opposed to the 100 or whatever that's in your portfolio? So I think that, yeah, having too much product assortment, because it just, you over invest in the inventory and then it leads to products going obsolete or wastage. Or I used to work at a consumer electronics distributor for a number of years. And the big thing there was around phone cases and phone launches. And so we'd invest, iPhone's the biggest one, but we're like, oh, let's also get in the Google one for Google Pixel and this one. And it's just like, the demand just isn't there. And then they're going to replenish it, within a year. So really, if you just focused on providing accessories for the iPhone, kind of solid. That being said, we had to, because the retailer wanted an assortment of products. So that was a decision. So it's something, sometimes you have to diversify to make the buyer happy, but you want to make that decision knowing that it's an investment. We've kind of covered it already, but like really important to just think about like demand planning and inventory as you're going through it, especially if you have product that could potentially expire or, you know, has some type of sell by date involved with it. Just having a really strong, robust process around that and taking into account all of the data that you can get if you're going into retailer, whether that be like inventory on hand at the distributor, at the stores, if you have that sell-through reports, taking that all into account to like make the right decisions for you. Because at the end of the day, you could even be liable for product that is going out of date at the retailer. So that's something to really think about. And then the other is around like technology integration, you know, having systems in place to like automate order processing, making sure that you're compliant from a labeling standpoint, and like consuming those routing guidelines is really key.
Yeah, and I'll add on to that, really on that same thread, that you're considering trade management and your trade plan with those things. You know, if you're going to run 3 BOGOs a year or 5 ads a year, those are going to have massive impacts on your volume. So back to her point with demand planning, everything, like, are you looping in what you think your trade strategy might be with that? And then upfront, you know, things like free fills, all the volume there. Number of times I've experienced getting into a new retailer and then, oops, we actually can't fill their initial giant order. Like, that's not a great start to the relationship. Or, you know, the slotting side of things, are you willing to make an investment that probably doesn't get paid back for 6 months as a business? Those areas are, I think, are also very important and are really tied together. And I think it's very difficult for a lot of companies to tie together things like trade spend with demand planning. It's often 2 different spreadsheets or 2 different tools, that sort of thing. But they have massive impacts on one another. You know, should you really sign up for this promotion if you know that you actually don't have the supply?
Mhm.
Don't go sign up for that promotion. Buyers hate it when you sign up for that promotion, they think you're going to be in the ad, and then you're trying to cancel it last minute and you're saying, that's because I won't be able to produce enough volume. Well, now they're going to go to one of your competitors and say, hey, you know, this brand just dropped out. I'm giving you the opportunity to get this awesome, you know, end cap now instead of them.